Hey everyone, welcome back to Corporate Decoder, the place where we decode the hidden secrets buried in the fine print of modern business. Today we are diving headfirst into FinWise Bancorp's latest quarterly report. And let me tell you, it is a wild ride from soaring loan numbers to some interesting shifts in risk. So FinWise Bancorp, they are the parent company for FinWise Bank. And like many banks, they make their money by taking deposits and then lending them out. But FinWise has a bit of a twist. They are heavily involved in what they call strategic programs, essentially partnering with fintech companies to originate a lot of loans. This has been a huge growth engine for them. But it also comes with its own set of risks and rewards. Let's jump right into the numbers to see how they are doing. Looking at their balance sheet as of the 30th of September 2025, we see total assets have jumped to nearly $900 million, up from about $746 million at the end of 2024. That is a solid 20% increase, and most of that growth is coming from their loans. Their loans held for investment, meaning loans they plan to keep for a while, are up by over 19%, sitting at a cool $533 million. And their loans held for sale, these are loans they plan to offload, have seen a massive 71% spike, reaching $156 million. This signals a really active lending operation. Now, how does this translate to the profit and loss? Well, their net interest income, which is basically the difference between what they earn on loans and securities and what they pay on deposits, is up 26% for the quarter compared to last year, hitting $18.6 million. For the first 9 months of the year, it is also up nearly 10%, reaching $47.6 million. That is good news, showing they are earning more on their assets. But here is where things get interesting. While their interest income is rising, so is their provision for credit losses. This is the money they set aside to cover potential bad loans. For the quarter, it jumped a whopping 493% to $12.8 million. And for the 9 months, it is up 171% to $20.9 million. This huge jump is largely due to the growth in their credit-enhanced loans, where they are taking on more risk. It is like saying, we're making more money, but we also need to be more careful because these loans might go bad. Now let's look at their non-interest income. This is income from sources other than traditional lending, like fees. This area has exploded, up 198% for the quarter to $18 million, and a massive 114% for the 9 months to $36.2 million. A big part of this boost comes from credit enhancement income, which shot up from just $47 for the quarter last year to $8.8 million this year. This is directly tied to those credit enhanced loans we just talked about, where partners provide a safety net and FinWise earns income from that. They also saw a nice 27% increase in strategic program fees, thanks to more loans being originated. On the expense side, their salaries and benefits are up 12% for the quarter and over 20% for the 9 months, reaching $31.1 million. This often reflects growth in staff and investments in retaining talent. However, their professional services costs have actually dropped significantly, down 34% for the quarter and 24% for the 9 months. This might mean they are bringing more functions in-house or have completed some major projects. So, what is the bottom line? Their net income for the quarter rose 41.6% to $4.9 million, and for the 9 months, it is up 22.4% to $12.2 million. So despite the jump in credit loss provisions, they are still growing their profits, largely driven by that booming non-interest income and the growth in their loan book. They have also restructured how they report their business, now breaking it down into 3 segments: traditional banking, banking as a service or BaaS, and treasury and administration. Traditional banking, which sounds like your everyday bank, contributed $806,000 in net income for the quarter. But it is the BaaS segment where they partner with fintech companies that is really shining, bringing in $3.4 million in net income for the quarter. This is where their strategic partnerships are clearly paying off. Looking at their overall financial health, their total assets have grown nicely. As of the 30th of September 2025, they stand at $899.9 million, up 20.6% since the end of 2024. This growth is primarily in their loans. Deposits, which are their main way of funding operations, have also seen a significant increase of 25.2%, reaching $682 million, with a good chunk of that coming from brokered time deposits. This means they are actively seeking funds from outside their local customer base to fuel their lending. Now back to those credit losses. Their allowance for credit losses has jumped from $13.2 million at the end of last year to $25.8 million by the 30th of September 2025. That is nearly double, and a large portion of that is tied to those credit-enhanced loans in their strategic programs. Clearly, This part of their business is growing and requires more provision for potential bumps in the road. When we look at non-performing assets, which are loans that borrowers are struggling to pay back, they've increased to $42.8 million. This is up from $36.5 million at the end of 2024. They attribute this rise partly to the SBA 7 loan portfolio, where higher interest rates are putting a strain on small business borrowers. This is a trend to watch closely, as rising interest rates can make it harder for many borrowers to keep up with payments. Their risk factors section flags that their credit enhancement arrangements with strategic program partners expose them to counterparty risk. This essentially means if their partner can't hold up their end of the deal to cover losses, FinWise could be on the hook for more. This is a critical point. They are relying on these partners for protection, and if those partners falter, FinWise's own risk goes up. So, what is my take on FinWise Bancorp after looking at this? They are clearly in a high growth phase, especially in their BaaS and strategic programs. Their ability to attract deposits and originate loans is impressive, and they are generating significant fee income. However, this growth comes at a cost. The massive increase in their provision for credit losses and the rise in non-performing assets signal that managing risk, especially within their strategic programs and SBA lending, is becoming increasingly important. They are taking on more risk, which is necessary for growth, but they need to ensure their credit enhancement partners are rock solid and that their underwriting, even in these fast-paced fintech partnerships, remains robust. The jump in non-interest income is a strong positive, showing they have diversified beyond just traditional interest income. But the increasing reliance on credit enhancement income and the potential counterparty risk with those partners is a significant factor to monitor. The company is evolving rapidly, and while the story is one of impressive expansion, it is also a story of increasing complexity and elevated risk that FinWise needs to manage very carefully. Their success hinges on balancing aggressive growth with prudent risk management, especially in a dynamic economic environment with rising interest rates. Alright, that was a deep dive into FinWise Bancorp's latest report. What are your initial thoughts on their growth strategy and the risks involved? Let me know your opinions in the comments below. If you found this breakdown helpful, please hit that like button and subscribe to Corporate Decoder for more insights like this. And hey, if you want to go even deeper and connect with other finance enthusiasts, join our Discord community. Link is in the description. Thanks for watching, and I'll see you in the next Decode.